Ladies and gentlemen, good day, and welcome to the investors conference call hosted by TruAlt Bioenergy Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. I now hand the conference over to Mr. Vijay Kumar Murugesh Nirani, Managing Director of TruAlt Bioenergy Limited. Thank you, and over to you, sir.
A very good afternoon, ladies and gentlemen, and thank you for joining this investors call. I will begin with the quarter's message. Energy today is central to a nation's economic strength and security. Recent global events have shown that dependence on external energy sources can rapidly translate into economic vulnerability, trade frictions, sanctions, and widespread supply chain disruptions. India's own experience during periods of global energy volatility reinforces a clear lesson. Long-term resilience lies in strengthening.
Ladies and gentlemen, we have lost the line of the management. Please stay connected while I reconnect the management. Thank you. Ladies and gentlemen, we have the management line reconnected. Sir, you may proceed.
Apologies, ladies and gentlemen, on the technical error. Continuing on the message, we are all aware of the importance of energy in today's geopolitics. India's dependence on import of crude, especially the Russian imports, have seen drastic impacts to as heavy as sanctions from the United States. Us, along with the global market players and government officials, have realized the importance of domestic capabilities on energy production and the importance of having energy independence. On this, I want to share a practical and strategic pathway to securing the country's energy future depends largely on the biofuels. With TruAlt Bioenergy, the first business verticals update on the quarter for ethanol sector, 2025 marked a significant national milestone, with India achieving its E20 target under the ethanol blended petrol program, underscoring the scale and maturity of the country's ethanol ecosystem. As the sector stands at the cusp of mandates beyond 20%, ethanol is increasingly being recognized not only as a blending solution but as a broader platform for value creation. Ongoing policy discussions around higher blending levels such as E27, potential ethanol blending in diesel, and the allocation of ethanol volumes for sustainable aviation fuel point to a materially expanding demand landscape, reinforcing the long-term structural strength of the sector. During the quarter, TruAlt Bioenergy completed a key phase of its operating consolidation, with the planned capital expenditure for grain-based integration now fully commissioned. The sugar crushing season in Karnataka commenced only from mid-November, resulting in approximately 58 effective operating days during Q3, during which 4 of the company's 5 ethanol plants were operational and achieved capacity utilization of over 95% on operating days. Unit 5 received its consent to operate on December 17, 2025, following which all ethanol plants are now fully operational with a monthly revenue run rate of approximately 350 to 400 crores in the ethanol segment. That is a gross production of around 5.5 to 6 crore liters per month. On a gross quarter basis, overall utilization for Q3 stood at approximately 60%, while utilization on operating days exceeded 95%. With the completion of the current CapEx program, no further expansion or capacity addition is planned across the ethanol business, and the company is now operating on a fully stabilized platform positioned to support monthly ethanol production in the range of approximately 5.5 to 6 crore liters. In the CBG business, we have achieved operating efficiencies that meaningfully exceed industry benchmarks, translating into strong and sustained financial performance. For the 9 months ended December 31, 2025, the CBG business recorded an EBITDA margin of 63% and a PAT margin of 43%, reflecting the depth and robustness of our operating model. Having moved decisively beyond the learning curve, our focus is now on disciplined scaling with plans to develop 24 greenfield CBG units over the next 2 to 3 years through joint ventures with Sumitomo Corporation and Maharatna PSU Gas Authority of India Limited, leveraging global expertise and national infrastructure. Policy momentum continues to provide a strong tailwind with excise duty exemptions announced in the recent Union Budget 2026-2027, along with the pipeline infrastructure support, CBG, CNG synchronization, and capital and market-linked incentives, materially improving project economics and long-term visibility. Our 4 new plants are being constructed and are scheduled to commission by July 2026 with Sumitomo. We're also happy to report that the DIPAM, Department of Infrastructure and Promotion, has given their approval for GAIL to infuse equity, and the equity infusion from GAIL in our second JV is scheduled to happen within the month of February, taking our 10 CBG plants with GAIL to start commissioning. In the sustainable aviation fuel segment, aviation is at a critical inflection point with growing urgency to reduce carbon emissions. As recognized under the CORSIA framework, SAF represents the only scalable pathway to decarbonize aviation. India is well positioned to capitalize on this opportunity, supported by a strong ethanol infrastructure, feedstock availability, and technological readiness. Against this backdrop, we have progressed with the technology licensing agreement with Honeywell UOP, with engineering design underway for a proposed 100 million liters per annum SAF facility in the state of Andhra Pradesh. While also advancing discussions with Sumitomo Corporation for potential equity participation, we are also at an advanced stage of approvals and are positive about receiving 150 crore of viability gap funding under the PM-JEevan scheme, strengthening project viability and positioning us ahead of the emerging SAF market. We are also creating a working group along with a leading oil manufacturing company and with an airline carrier who could potentially be partners in the aviation fuel business. In our retail business, in biofuel retail network segment, we received our oil marketing company license and commissioned 7 outlets within 6 months, which is a record time, with 4 additional stations underway and visibility to scale approximately 75 outlets in the calendar year FY26, aligned to be future ready with the expected adoption of flex fuel in India. As we move forward, our focus remains clear: to deliver consistent financial performance, to invest with discipline and purpose, and to create enduring value for shareholders while contributing meaningfully to India's energy security and transition goals. With that, I now pass on the call to our CFO to present the financial performance.
Good afternoon, all. So taking from here forward what our MD has explained, the company has already published the financials on the 3rd of this month itself. So just to present the console financials and financial results of 9 months ended 31st December 25, the company has done the top line of total income of 1187 crore for the 9 months ended as compared to the previous 9 month ended of 1047 crore, showing a significant growth rate of 13.28% in terms of percentage and 139.20 crore in terms of numbers. The company has further booked the expenses also in the proportion. The company COGS has increased from 673 crore to 805 crore, showing a growth in the COGS by 19.55%, against which the company has grown the revenue of 14%. So this being the reason, although my COGS has gone up a minor way more than the income, the reason being was my plant was only operational during the quarter for 48 to 50 number of days. So this, since the plant could not utilize the complete, the fixed cost was booked for totally for 9 months, but the revenue was in proportion booked only for the partial period of 48 to 50 days, impacting the margin maintained by the company. The employee benefit expenses has grown from the company from 28.14 crore to 34.3 crore, showing a growth rate of employee expenses by 21.95%, being the reason the company is in the expansion mode and doing the additional hiring. The company finance cost has gone up from 104 crore to 116 crore, with a growth of 11.38%, with the CapEx company has recently planned in terms of a CBG sector, the multi-feeder plant grain sector, and the company is paying the interest also in line the reason for increase the finance cost. The company debt has increased from 49.38 crore to 63.28 crore, showing a significant and major impact on the expenses of the company, which has increased by 14% overall, having the contribution of 28% only by way of a debt. The reason being the company has capitalized in their book the 600 KLPD of assets which company is doing the expansion in the second phase for molasses waste. This being the reason the company depreciation has gone up by close to 14 crore. Although the total expenses of the company has gone up by 14.16% in compared to my previous 9 months, and the company top line has grown by 139.20 crore compared to previous 9 months. Now coming to the profit before tax booked by the company. The company PBT has almost in the line compared to previous 9 months. 48.54 crore was the PBT in FY25 9-month ended, which is now standing at 46.25 crore, showing a marginal dip, even though my plant was not operation and complete shutdown for Q2, and also it was partial shutdown in Q3, where I already explained that the company operated only the plant for 40 to 50 days. But the company has absorbed the full fixed cost of entire 9 months. The profit after tax booked by the company was at 34.94 crore in the previous quarter, in the previous 9 months, which now is at 35.92 crore, showing a growth in the PAT of the company on the consolidated basis. And also the EBITDA on the company, which was 155.43 crore, has booked to the EBITDA of 170.99 crore on compared to FY25. The reason for my thinner of the EBITDA margin was already explained. The point number 1 was the plant which was has run only for partial number of 48 days. That's the reason number 1. And the reason number 2, the more cost absorbed by the debt and finance cost by the company and impacting the further the PAT, the deferred tax asset liability calculation. Now I will like to present the quarterly consolidated financials of the company to give the true picture what we have done after, even though plant was shut down, how the company has performed on the quarterly basis. The revenue from again the total income of the company in the previous quarter was 430.5 crore, which is stood at now has rise by 730.86 crore, showing a major growth of 70% in the top line of the company in terms of a percentage, and in terms of a number 300 crore, the top line has grown. The company COGS was again has gone to double, which was 206 crore, has gone to 493.76 crore. The company employee benefit expenses was 10.22 crore, which has gone to 12.46 crore. The already stated the reason of the expansion of the company being the reason for this. The finance cost, which was 35.97 crore, has gone up to 40.13 crore. Again, the reason has been explained in the 9 months ended financials, because we have gone for the additional expansion. The finance cost has been where finance cost has been made, but the cash flow generation is yet to come. So that being, once the cash flow generation will come, this finance cost will be automatically absorbed. The depreciation of the company, which was 17.66 crore, has now stood at to 21.81 crore, showing a major impact on our expenses. But that is, my debt has gone by 23.46%. That was a one-time capitalization process, which is completed, leading to the rise in the depreciation figure. With this, the company profit before tax, which was standing at 86.39 crore in my previous quarter, has now come to 89.68 crore, showing a growth in my profit before tax by 3.29%. But my profit after tax, if you will see, which was 75.19 crore in the previous quarter of the last year, has come down to 69.19 crore. The major reason is the calculation of deferred tax DTA and DTL impact has made a minor downfall in the PAT, even though my PBT has gone up. So with this, if you will see the overall outlook of the company, with multi-grain operations ramping up and utilizations improving, Q4 FY26 is expected to see a stronger revenue momentum and a margin in expansions as assets are absorbed and company will be able to run more efficiently, and measure of the fixed costs are already booked in the financials of the company. I would just like to have a small glance on my CBG segments, which are a key driver to my revenue. The CBG segments, which was for the 9 months ended, which have given the revenue contribution of 19.89 crore in the previous 9 months, has now jumped to 30.97 crore, with a CBG jump alone contributing 55.68%. The reason being why we are coming up with a 24 node additional CBG plants, which was explained by our MD. The EBITDA percentage in this segment has grown from 44% to 63.34% of CBG, and the PAT margin has grown from 23% in my previous 9 months to 43.38% in my CBG segments. And just to give the 9 months standalone basis, the financial ratios booked by the company. The company current liquidity ratio, current ratio is stood at 1.53, showing the robust growth. The company solvency debt equity was at 0.65, and the company return on capital and return on equity is also in line. So with this, I will like to
Open up for questions.
open the forum for the question answers from investors.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Achal Jalan from Lotus Wealth. Please go ahead.
Hello. So my question is around the sustainable aviation fuel. So for aviation companies to shift to SAF, they would require certain permissions and licenses and certain changes to the engine compatibility also. If these outcomes are not as desired, then our demand could be highly impacted. So can you please provide some color around the same?
Thank you so much for that, Anju. So in the SAF, there is already an approval by ASTM that alcohol to jet route, the technology that we are using to convert ethanol into SAF molecules, we can, in all the engines that are currently in operation, the air turbines, we can go up to 50% of blending using the alcohol to jet route, using ethanol to jet SAF. So the process of the approvals for blending up to 50% is already in place, and there are places where blending of SAF is already being done. That is part one. Second part is to the policy approvals. Government of India, along with multiple other developed nations, have already taken mandates, and India's mandate is going to kick in from FY27 onwards, where 1% of blending is scheduled, 2% by 28 and 5% by 2030. There is already a 3-ministerial working group created between Ministry of Civil Aviation, Ministry of Petroleum and Ministry of Environment, and also Ministry of New and Renewable Energy, MNRE, for coming out with a policy. So we expect the policy to come out very soon, and our objective is to sell at least 20 crore liters of ethanol from the ethanol vertical to this JV company or the SAF business vertical to create 10 crore liters of SAF.
Okay, sir. So from your side, you don't think that the engine compatibility or the permissions or licenses could be an issue to the demand side, right?
No, this is not my view. This is the view of the technology, the engine manufacturers and the approvers of the global standard, the standard bureaus. So ASTM is called American Standards for Testing and Testing Methods, and even BIS and the other relevant global standards agencies have already approved up to 50% of blending of SAF into ATF using the alcohol to jet route. You could read more about it online.
Okay, sir. Thank you.
Thank you.
Thank you. We take the next question from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Yeah, I'm audible, sir.
Yes, sir.
Yeah, thank you very much, sir, for this opportunity. So just wanted to check, now we are currently at 5.5 to 6 crores of monthly ethanol, right? That's run rate. So is that the optimum level? All the 5 units are running at optimum levels?
That is correct, sir. So our installed capacity is 2,000 kiloliters per day. And on grains and molasses, when we use grains and molasses, it goes up to 2,100 kiloliters per day. So considering a 90% capacity use, 5.5 crore liters becomes an optimal use case. And higher ratios should give us about 6 crore liters per month. That's at peak 100% capacity use.
Should be 90 to 100% utilization, right?
Yeah, at 100% utilization, we will get 6 crore liters per month, and at 90% utilization, it should be about 5.4 to 5.5 crore liters.
Okay, understood. And coming to your just a small data point, what was your volume in third quarter? The ethanol volume?
Quarter 3, we did a gross volume of about 7.6 crore liters.
Mm-hmm.
And this is because we operated the capacity, like our CFO mentioned, for a period of only 58 days.
Correct. Okay.
This was largely due to the farmer protest in the state of Karnataka, where there was a blockage of roads and the entire infrastructure was put to a halt. Not just for us, for the entire sector.
Okay, I got it. And now on SAF, this Andhra plant that we are coming up with 10 crores liter per annum capacity. So what's the timeline and what's the capex involved there?
We have projected a capex of about upwards of 2,000 crores to set up the plant.
Mm-hmm.
And we have already, just 3 days ago, we were in Andhra Pradesh to finalize the land. We were in Srikakulam, and we have already identified the land, and the approval processes are in way. So we've already applied to the environmental clearance, land procurement, and the incentive package with the state of Andhra Pradesh is in advanced stage as we speak. And there is also an incentive from Government of India for up to 150 crores, which I mentioned in the message earlier. That is also in the final stages of being approved. So with that said, we have already also given the licensing agreement, and we have signed off for the feed with Honeywell. So once that comes through, our target to complete this project will be by July to October of 2027.
July to October of 2027.
That's right. So FY28 we should start seeing revenues coming in.
Commercial production and revenue can start. July to October.
That's right. In FY28 we should start seeing revenues.
Okay, understood. And what's the realization per liter for SAF?
So minus the policy clarity yet, globally the SAF is being traded at 3x of what air turbine fuel is sold at. So currently ATF is at 110. And global prices are almost at about $3 to $4 per liter of SAF. We are expecting only 2x of what ATF is at currently. So our estimates on sales price is around 200 rupees a liter, 180 to 200 rupees a liter.
180 to 200 rupees per liter of SAF, right?
That's correct.
Okay, understood. I got it. And how should one look at your revenue mix of ethanol, CBGs, and SAF, if I have to see next 3 to 5 years down the line? I mean, currently a majority comes from ethanol, right? But CBG and SAF would be our upcoming sector. So how should one look at the mix? And also, what is the margins one can expect in SAF?
So, Deepak, I'll just give you a ballpark range because I may not be allowed to accurately give out this thing.
Mm-hmm.
So, ethanol you have seen it's peaked out. So, let's say at 6 crore liters, 5.5 crore liters, or let's say 5 crore liters into 300 days, and expecting a 18-20% EBITDA, you could do the math. That's the peak level in the ethanol sector.
Okay.
In the CBG business, we are setting up 24 plants. 10 with GAIL, which are all 12 TPDs each. And with Sumitomo, it is 12 plants. First 4 are 20 TPD each, and the rest will be between 12 to 20 TPDs each. we're expecting between 0.8 to 1 times the asset turn, 0.8 times to 1 time the asset turn in terms of revenue. And let's say you factor the similar EBITDA that we have achieved in the last month, and you could do the math for peak levels. So I do not want to give a range. So meaning at least you can do the math there. And when we speak of aviation fuel, we are looking at an EBITDA of somewhere between 22 to 25%. That's our target I mean, that's the economic viability that we have assessed.
Okay, understood. And just one last thing, what's the capex involved in CBG, that 24 plants?
So with the GAIL plants, sir, the 12 TPDs will cost us 60 to 65 crores each. So that should be about 650 odd crores. And with Sumitomo, the 20 TPD plants are costing us 85 crores each. Phase 1, that is the 4 plants, will cost us 340 crores. Phase 2 and Phase 3 will also cost us around 340 crores. So gross it will be about around 940 to 980 crores, give or take close to 1,000 crores for the Sumitomo JV and about 600 crores for the 650 crores for the GAIL JV.
Okay, so total is 1650. So 650 for GAIL and 1,000 crores odd for the Sumitomo.
That's right, sir.
Okay, fair enough. That's very helpful, sir. I mean, I wish you all the very best. That's it from my side.
Thank you so much.
Thank you so much.
So most of the revenue growth and the revenue drivers will come from the utilization of current infrastructure and CBG.
Mm-hmm. Correct. Fair. Yeah. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. We take the next question from the line of Charchit Malu from Genuity Capital. Please go ahead.
Hi, sir. Am I audible?
Yes, sir.
Hi. Thanks a lot for the opportunity, sir. Sir, I have a question on the DDGS. So for this current quarter, what was the revenue from DDGS and like what kind of realization do we have for Q3 of 26?
So in the Q3, we operated most of the plants on syrup and only one plant was on maize. So we had a revenue of around 18 crores for DDGS for the last quarter. And for the quarter to come, we expect a revenue of somewhere about, considering the production plan, should be upwards of about 70 to 80 crores for DDGS.
In Q4?
In Q4, yeah.
Okay. Okay. My next question is on like, are we selling any of our products to private players as well, sir?
Products of ethanol, you mean?
Yes, yes.
Yes, sir. So we have contracted with Nayara and we have contracted with GOBP for ethanol blending with petrol. So there is a decent quantity coming in from both of them.
Great. So like, and what kind of EBITDA margins do we have on DDGS, sir?
So when we calculate the gross revenues and then cut down on the expenses, that is how we arrived at that 18 to 20% of EBITDA. So let's say DDGS is a byproduct. When we say byproduct, cost of the making DDGS is already captured in the gross revenue.
Okay, understood. And like, are we still on the line of like doing 47 crores for ethanol in FY26?
This FY26, our gross sales will be somewhere, we had projected about 41 odd crores earlier. And unfortunately, we delayed the setting up of the grain plants and we had a quarter down. And you're aware of it, last quarter and almost about 30 days we lost during the start of Q3. Due to which we are projecting a revised production of about 36 to 37 crore liters for the year.
36 to 37 for the year. Okay. And like what kind of EBITDA margin are we targeting for Q4?
It is looking somewhere in the range of 20 to 22%.
Okay. Great, sir. Thanks a lot and have a nice day.
This is the projected EBITDA of about 20 to 22%. That is what we are trying to achieve.
Okay, sir. Okay. Thanks a lot.
Sorry.
Thank you. We take the next question from the line of Pratham Modi from HPMG Shares and Securities. Please go ahead.
Hello, sir. Good afternoon. Am I audible?
Yes, please.
So, following the recent High Court's direction granting consideration for a 90-day extension to supply the ethanol shortfall, how confident is the management about OMCs lifting the entire contracted value of approximately 1,075 crore within the extended timeline?
So this is regards to the quantities that the earlier caller also had about achieving that 41-42 crore liters of sales. We've got a shortfall quantity that is carried over from last ethanol supply year, which ended in October 2025. So we had because the reasons of delay were beyond our control, and this falls under the force majeure condition. Our region, when we were doing the integration of the plant, saw extreme rainfall and severe climatic conditions, which delayed us in setting up the plant. So considering that, court has given us the approval for extension. And on a lighter note, our relationship with OMC is like a marriage. So we keep fighting, and eventually, when the fight is too large, we end up getting that approval. So this fight is just begun now, and I'm sure they will come through. And because they require ethanol and we have ethanol, so I'm sure that we will come through. So
Timeline will be difficult to tell, but then this, if you might have gone to the order says mandamus, which is a very strong word in terms of instruction given to the OMCs.
Right, sir. If I may ask another question, could you please share some insight on the recent increase in purchase of stock in trade?
that I'm not sure. I think I should have to ask the investor community what's happening to.
Sure.
We are not sure of the reason why it had a downfall. We are not sure of the reason why it has an uptrend. I think, it's all dependent on you as to how you, punish or benefit. I mean, would you appreciate us?
Sure. Yeah. Okay. Thank you so much. That's it from my side.
Thank you. We take the next question from the line of Piyush Bangar from Vijit Global Securities Private Limited. Please go ahead.
Hello, and thank you for the opportunity. I just have two questions. The first one is that related to the sustainable aviation fuel, that we are doing a capex of somewhere about 2,250 crore rupees for getting a 310 KLPD of sustainable aviation fuel, which sums up to the capex of somewhere about 7.5 crores per KLPD. Don't you think that this, matrix is comparatively is on the higher side? And if it is, what is the reason for the same?
Thank you so much for that. It's definitely on a very higher side, POC, because one, this is going to be one of the largest plant in the world, right? It is supposed to be amongst the top 5 largest plants in the announced project in SAF. Number two, because it's the initial phases, the cost of the project is usually higher because technology transfer fee and, the cushions for risks involved and for the EPC and the technology provider is usually higher. So the cost is definitely high, and which is why there are two schemes. One is the PM Jeevan Yojana, where 150 crores viability gap funding is almost at the final stage with Government of India for this intended project. And second is in the state of Andhra Pradesh, there is the integrated clean energy policy, which almost gives 1.5 crores per KL of capital subsidy, which we are negotiating with the Andhra government to increase it to a certain level. So even considering 1.5 crores per KL gives us almost about 450 crores of subsidy with the integrated clean energy policy. And there is a SGST exemption. So on 2,000 crores, SGST itself works out to the 9% of it, you can do the math. So that's another subsidy that is available there. So all in, once the plant is commissioned, there is a huge chunk of capital coming in as viability gap funding and incentives that will go on to knock off the debt. So being one of the first movers has this, the disadvantage of, bearing the risks of technology and all of it, and the advantage of the incentives and the policy benefits.
Fair enough. My second question is related to the major segments, which, as you have also said previously, that ethanol and CBG are all major drivers. I just want to know the kind of revenue potential or business outlook for Q4 FY26 as well as for the H1 FY27. based on the current existing capacity and avoiding the raw material fluctuations which usually companies face?
So Piyush, I'm not allowed to give out that the outlook, but in the range of, I'll give you production range is somewhere around 5.5 to 6 crore liters on a monthly basis. And the idea is to sell the whole quantity. So that should be the outlook for the next quarter.
So we have already shared the plan on the expansion number of plants which is coming up in a year or two. The number of capacity we are working on the SAF and the other segments. So if I think you will be better to work out the numbers.
Okay, so what kind of capacity utilization we can achieve in Q4 and H1 FY27?
For Q4, we project at least about 90 to 95% between that number for capacity use. And all 5 units of ours, 2000
from sugarcane.
No, sir. It has mix of grains as well as sugar derivatives.
Okay. And
1300 kL is with grains. Out of the 1300, we will be operating Feb and March part of the capacity with grains, and most of the capacities will be with molasses.
And what about the next year, the H1?
H1, instead of H1, I would say Q1, which should also be similar ranges. We are projecting a 80% capacity use for Q1 because all the capacity is in play. And Q2 usually is a downtime. So 2 months is scheduled maintenance during Q2 because we plan to operate only on a 300-day basis out of 365 days. So that would be the visibility for Q1 and Q2 for next year also.
Okay, thank you very much for the opportunity. Thanks.
Thank you. We take the next question from the line of Prashant Shah, who is an individual investor. Please go ahead.
Hello, is my voice audible?
Yes, sir.
So I had one general question. In terms of SAF, worldwide, I mean, outside of India, what is the trend? I mean, which are the major airlines using SAF and what is the blending of ethanol into fuel in the developed countries?
Okay. So globally, there is already a mandate, sir, and airline carriers like Qantas, Norwegian Airlines, to an extent Lufthansa, United Airways in America, all these have already made public announcements for consuming. If you look at the domestic also, recently Air India and Indian Oil have also made an announcement for long-term use of SAF into the ATF mix. So globally, there is consumption that has already started since 2025 onwards. Now, just to give you clarity, sir, CORSIA, that is the body that regulates carbon emissions, has given mandates on a voluntary basis from 2024 onwards and on a mandate basis from 2027 onwards. So 2027, that is next year onwards, globally it is going to be a compulsory blending. But a few countries, European Union is actually putting taxes, the carbon taxes for promoting use of SAF, whereas certain countries, India is still deriving its policy as to how that promotion has to happen. So we are waiting for the Indian policy framework as to how they will actually promote the consumption.
So understood, Mike. Okay, so let me put it different way. I mean, one is that I mean I know there is a guideline given and a kind of a voluntary mandate. The other is a directive or a executive order. So if my understanding is correct, it is now. As of now, it is up to the discretion of the major airlines. You know, the names you mentioned, Lufthansa and United and all those. It is their discretion whether they want to have a fuel with ethanol blend or not. But it is not a compulsion or a direction. And that will come from probably a few years down the line. Is that understanding correct?
It is part correct, sir. The voluntary portion was from 2024 to 2027, and the mandate to compulsorily consume for developed nations is from 2027 onwards. But The concern right now is most of the countries have not still given out the roadmap, because next year onwards, the blending targets need to begin. And Government of India has already announced in multiple forums that they have targets to come out with a SAF policy in the next few months itself, within this year. So once the policy comes out, whether they use carrots or whether they use stick to implement this, it is to be waited and seen. I'll just give you an example of ethanol EBP program, the ethanol with petrol program. Government came around in 2019 and said, if you don't blend ethanol with petrol, there is a 2 rupee cess that will be levied to the oil marketing companies. And because of that cess alone, everybody came around and said, okay, we will do the blending, the oil marketing companies. So in the aviation fuel also, whether it's going to be a cess/tax or whether it's going to be an incentive to the framework, that is to be seen.
Okay. So, I mean, in a way, there is always a risk that the implementation deadline can be, pushed backwards. So instead of 27, it can become 29, and it depends on negotiations. From our limited perspective, let's say, I mean, we hope that there is no change, but if the deadline is pushed backwards by a couple of years, how will that impact the CapEx plans that we are having and the utilization? You mentioned that, I mean, in the next year onwards, you look at around 84% utilization. So if the deadlines are pushed backwards, how will that impact our plans?
Thanks for that, sir. It's an important aspect. Now, our whole investment strategy is not in the expectation that tomorrow government will come with a policy. Our investment strategy is structured based on offtake guarantees before we commit on-ground investments. Now, why I say that, we are already under a MOU with a large oil and gas domestic carrier, and a domestic oil and gas player, sorry, and a large French-based airline manufacturer also, through whom we are negotiating on offtake structure. So we want to be less dependent on policy-driven matter, but also be structured so that we can export out these fuels where there is voluntary purchase and which is binded by a offtake agreement. So in the next few months, our target is to achieve that and be less dependent on policy framework.
Okay. Fair enough. And that's a very good update. And just the last one, I mean, we are covering surface transportation, we are covering air transportation. What about sea? I mean, because bunker fuel is also a very large, petrocarbon product that is being used. So are there any developments happening, and what are we doing any research or product development to have ethanol blending in bunker fuel also?
Thanks for that, sir. So if you see, our fifth business vertical is going to be advanced biofuels or advanced chemicals. Now, I'm just giving 3-4 potentials. I'm not saying we have committed already. One is green methanol, one is green ammonia, one is green hydrogen. These are 3 fuels. Green ammonia and methanol are good bunker fuels. Now, one of our peer companies, or rather are called AM Green or Greenco, you are aware that green ammonia, they've already signed off and they've already started capex on the same. Very recently, last week in India Energy Week, we had a good discussion with one of a large port operator who wants to do a pilot plant to set up methanol using Fischer-Tropsch. So for that, you require carbon dioxide, CO2, and you require hydrogen. And while making ethanol, we have a lot of CO2 that is generated. So that we have that ample or excess amount of CO2, and future green hydrogen can give us potential to make methanol, green methanol, which acts as a bunker fuel. These are all future potentials that we have kept. So we are not actually putting all eggs, or rather investing across all portfolios just yet. The potential for growth in the biofuel space is very, very large. That is, I would want to leave it at that.
Okay. That's all from my side, and wish you all the best.
Thank you so much, sir.
Thank you. We take the next question from the line of Acharjit Malu from Genuity Capital. Please go ahead.
Hi, sir. Am I audible?
Yes, sir, please.
Yeah. So, like, what kind of realizations do we have, like, for Q3? Because, like, I back calculated, it comes out to be close to 80 to 85, right, per liter. So, are we able to maintain this kind of realization going forward as well?
Sorry, could you repeat the question, please?
So what kind of realizations do we had in Q3 FY26 for ethanol?
No, realization for ethanol is predate. It's already fixed, sir, so the price doesn't change. For maize, it is around 71 rupees. For syrup, it is 65 rupees. I don't have just exact number of production liters we have, but 7.8 odd crore liters is the production for the quarter. And our average realization is around 67 rupees or something.
Great. Okay. So just wanted to understand the economics of DDGS, like from how much ethanol are we producing, like from how much ethanol we are producing, like how much DDGS. Just wanted to understand broad economics of this.
Okay. So, a ton of agri products, maize and rice, gives us close to 16 to 20, let's say 18% of DDGS. That is the gross volume whenever we operate the capacity on grains. And price of DDGS, sir, usually hovers between 15, 16 rupees a kg to as high as 34, 35 rupees a kg. I just want to keep you informed that recently in the US trade deal, we are hearing rumors / information that DDGS has been allowed for import up to 5 lakh metric tons. So when that comes through, we might be seeing an average price of around 22 to 26 rupees.
Right. No, like I just had a question regarding from how much ethanol we are able to produce, like X percentage of DDGS, if you can give.
That's the same thing, sir. Just to again clarify. So let's say 1300 crore liters of 1300 KLPD of my capacity is grain based. When I operate my plant on grains, I will have around 18% of revenue coming in as DDGS. So I may have missed out and told the revenue that is expected from DDGS next quarter. But in the Q4, we will be operating certain of the quantities on maize and certain of our quantities on syrup and molasses. So my expected DDGS, I would not be able to give the exact quantity, but we will have a good portion of DDGS revenue coming in Q4.
Great, sir. Great. So just one more thing.
What you are answering, what you are questioning is, per metric ton of grain will give a yield of DDGS of 18 to 19%.
18 to 19%. Great. Okay. So one more thing. Like, what was the percentage of our sales from the retail, and what kind of margin do we had?
It was relatively quite low. Our total 48 rupees. You want to take it up?
So for the retail sale through that is dispensing station, we have this quarter we have done the 48 crore of sales. This being the reason we have only established 7 dispensing stations and 4 under process. Adding the more dispensing stations, the volume will go in the proportionate like anything, because we have the plan to complete at least 75 to 80 dispensing stations by 31st March. So as of now, the top line through dispensing station contribution in the total revenue of 1,200 crore, close to 48 to 50 crore is from the retail police stations.
One correction, not 31st March, it will be for the calendar year, 75 retail outlets. And the margin we achieved last was 2%, and the margin when at full scale, we should go a little higher because we have cost. You saw the employee cost go up because it's a growing company. We are hiring a lot of people to develop all these sectors, verticals.
Okay, great. Just one last thing. Which quarter will see our grain usage the most, and like what kind of, and like our profitability for that quarter will be different due to DDGS?
It will be Q1 and Q3. Q1 and Q2 will have more of grain.
And like our profitability will impact due to DDGS in that quarter, Q1 and Q3?
It will go up, right? Considering the current market price of maize, the margins should be higher is what our expectation is when we run it on maize.
Okay, sir. Okay, great. Thanks a lot, and sir, have a nice day.
Thank you. Thank you.
Thank you. We take the next question from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, I'm audible, sir.
Yes, sir.
Yeah, thank you very much, sir, once again. So just on the volume, I just trying to understand on the ethanol volume side. In the 9 months, our volume is close to 13.5 crores, right?
Correct.
And now, given the optimum at 5.5 to 6 crores, even if I end at a higher end of monthly 6 crores, so it adds about 18 crores. So that comes to around 31.5 crores. So, but I think you mentioned somewhere 36 to 37. So how, I mean, I'm not able to get the maths then, yeah.
We have underlying stock also, sir, available.
Okay. So how much would be the stock we have?
Currently, it should be around 5 crore. Around 5 crore liters, 5.2 crore liters, give or take.
5.2 crores liter of stocks.
That's it.
Okay. And so we'll be able to sell the whatever we produce plus the stocks, right? That's what we are saying.
That's our effort, sir. Like I said again, it's always a push and pull with the OMCs.
Yeah.
Our efforts are always to ensure sales go ahead as quickly as possible because price is fixed.
So a good amount of figure was on 31st December was sale in transit also, which was not booked in the revenue. So that will be again adding to what you are doing the calculation that will again work out there. If that is the gap plus the inventory is the gap.
Okay. So now I understand now how are we getting to 36, 37. Okay. That's helpful. And in terms of your CBG plant.
Again, I've been advised by to just take it with this thing that we are not allowed to project. So we're just giving the range, right? So just to be clear.
Yeah, fair point. No problem on that. And on the
my
CBG,
company secretary sitting next to me is nudging me. That's why. So.
So on the CBG, what's the timeline? I mean, can you throw some light? I mean, I think out of 24 plants currently, one is operational. Would that be right? And what would be the timeline of these plants to be operational?
I'll break it down for you, sir.
Yes,
Plant 1, which is a 10 TPD, is in operation since 2021. And now you've seen the revenues and the margins. It's at almost peak levels. Right. We are doing 4 more plants which began construction in December. And we project to complete, we propose to complete it by June 2026 itself, in the next 3-4 months. And that will be 80 TPDs of capacity, gross capacity. 20 TPD.
20 TPD per plant, yeah. Okay.
That's correct. And the revenue numbers, you could prorate it to what we've achieved in the CBG first plant, right? 10 TPD is giving 40 crores per annum.
Correct. I mean, yeah, that's correct.
And phase 2 of Sumitomo, we expect it in year 2, that is the next financial year, starting in, say, June or October, construction between that period. That is the next 4 plants. And phase 3 will be in the next financial year, that is starting in June of FY27, 28.
9 months from the FY29 revenue.
So it takes about 8 to 10 months to commission the plants. That is on the first 12 plants, Deepakji. And with GAIL, we have got first 5 plants under phase 1. That is the expectation. Lands, everything have been identified. And I did mention that DIPAM has also given that blessing to GAIL to make the investment. We are hoping that in February we have a small event and they buy equity and the JV starts. So phase 1 we will do 5 plants of 12 TPD each. That will take us 10 months to commission. Let's say first week of April or second week of April, we start the capex. I'm taking conservative numbers here because then being a PSU, they have certain approval process.
So by Jan-Feb 27, it will become up and running. So by FY27 end, we would have how many? I mean, at least 12 plants up and running?
We should have, say, 8 plus 5.
13.
Yes. Plus 1, 14. One already operational.
One already operational. Incremental 13 would be coming.
Yes.
So if I have to look at FY27 growth drivers, so that would majorly be your optimum utilization of ethanol plus whatever incremental revenue that can come from CBG, right? Now the retail being very small.
Our performance litmus test to all our investors is to ensure 55 crore liters of production in my ethanol, which is today at 35, 36, or let's say 37 for this year. To demonstrate that production and sales. and in my CBG business to at least achieve the commissioning and operation there. So my two drivers for next year is going to be these two.
Okay. So 55 crores liter ethanol is the volume we might target for next year, right?
This should be my focus, our focus.
Fair point. Okay. That would be it from my side. All the way best. Thank you.
Thank you. We take the next question from the line of Ankur Gulati from Genuity Capital. Please go ahead.
Hi, am I audible?
Yes, sir.
See, quick question. You said you will be operational for 300 days. Just wanted the basic understanding that you have grains now. So does it mean even with grains, you won't be able to operate for entire 360 days?
So since it's a manufacturing industry, Ankurji, you usually factor for a mechanical maintenance. So it is possible for us to operate at 330 days, but we will require this incremental 30-35 days as mechanical maintenance. It could be in intervals of shutdown, or it could be in a continued phase shutdown. You do require that mechanical maintenance because you have rotatory equipment, you have a lot of wear and tear that happens. So RNM has to be factored. We are factoring 300 instead of 365 as a base case scenario. That should be our effort.
Okay, so practically, because what we picked up from other multi-feed guys, that 330 is pragmatic. I understand you're working with 300 from a guidance perspective. Is that a fair statement?
I would like to say yes to that. But I mean, having a 300-day operation at this scale is also quite large. So 50-55 crore liters in today's ethanol economics is quite large.
Okay, and when the retail outlets that you're setting up, there the blending part, feed is going from your own ethanol factories. Is it fair?
That is correct, sir. So the whole idea of entering into the retail vertical, of course, one is to be customer facing. Second important one is margin on ethanol for us when blended has much higher economics.
So the ethanol plant utilization guidance today you have given, does that factor in your own retail network, or is that excluding your retail network?
It is excluding the retail network just yet, sir. And my retail outlets will not be big needle mover because let's say we are setting up 250 retail outlets at peak, which will be done by 2029.
Okay.
And we'll end up making close to about 30 crore liters of sales, gross fuel sales. And 1:2 would be the ratio of petrol and diesel. So 10 crore liters could be my petrol. And let's say in that 20% of ethanol is blended, 2 crore liters of ethanol could be what I'm just giving you potentials for future, right?
So less than 10%.
Not exact numbers. This is just a gross projection.
Okay.
So it's not a big needle mover.
Perfect.
But just to again keep you highlighted is one, the blending keeps improving from 20 to 27, E85, flex fuels, all those come in. That is when the business will have fun. That vertical will have fun.
Perfect. Second, again, the ethanol guidance for this financial year, coming financial year, does it factor in private OMCs, or is it only based on tender that you have so far?
Yes, I think that was addressed earlier. Deepak ji had the same question probably. It does have the private OMCs also, which Geo, BP and Nayara also have placed certain volume quantities and we are supplying to them.
And pardon my lack of knowledge, but there also the prices are fixed, right? That's not an open to market.
Yes, sir. That's right, sir.
Okay.
But usually they come around with a dynamic pricing. They're not mandated by Government of India's pricing, but they usually come around and give a little higher than the government pricing. So this year also, for the certain feedstock volume, they have given us a better realization.
Got it. Okay. Thanks a lot and all the best.
Thank you, sir.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to Mr. Vijay Kumar Murugesh Nilani for closing comments.
I thank all of our stakeholders, our investors for joining the call today and continuing to keep faith in this emerging business opportunity that is the biofuel space. We are again at the crossroads of increasing blending and the policy framework, and the energy transition vertical has a huge potential is what we see, and which is why we have created this platform to participate in the energy transition business opportunity. And again, I express my deepest thanks to all our investors and stakeholders for believing in the story and partnering with us to build a meaningful infrastructure to help India achieve energy independence. Thank you again for joining.
Thank you. On behalf of TruAlt Bioenergy Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.